All right, so what are some of the behaviors that can position you for market success during periods of market volatility? Well, the first is to remember the first rule of investing. And the first rule of investing is to buy low and sell high. As simple as that sounds in theory, it is much harder to practice in reality. But all you need to know when following that rule is if you have a desire to pull your money out of the market because it experienced a loss, then you are not following the first rule of investing. In reality, a period like this is the ideal time, assuming you have a long time to invest, to put money into the market. So, as tough of a conversation as it is to have when people have been calling me this week and they have a long time to invest, but they're terrified of what's going on, and they ask me what they should be doing, I'm telling them if you have money in savings, if your consumer debt is low and you can afford to put more money in the market, now is the time to put money in the market because prices are low. There's a more crude saying that we've shared on the podcast in the past, and that is when there's blood in the streets, buy property. It's essentially telling you that when things look the craziest, it is often during those periods that people gain property and put themselves ahead of their peers because they're taking advantage of that fear and using it as an opportunity to buy distressed assets. The next question, however, is how do you put money in the market? And my recommendation would be to do so through what's called dollar cost averaging. This is another concept that we've discussed on the podcast. It's far more complicated in terms of the term than it is what you're actually doing. All dollar cost averaging is putting money in the market in increments. So instead of plopping it all in at once, you are taking a 3-month period or a 6-month period or an every 2 weeks period like your 401k, and you're putting in equal amounts in each of those increments. A lot of us don't have perfect timing when it comes to when we buy a stock. We think we have found some tip that's going to make us all the money in the world. And by the time we actually purchase it, the growth has already been experienced. And because you don't know the timing, what dollar cost averaging hopes to do is to get you the lowest average price per share over an extended period of time. It's supposed to take the guesswork out of trying to time the market. Now, the great thing is if you have a 401k or a 403b, you're already practicing dollar cost averaging without even knowing it. You're doing biweekly payroll contributions to that account. And as long as you keep making those contributions, you're giving yourself a good opportunity during periods when the stock market is low to still have money hitting the market. And outside of your 401k, if you do have money to invest in things like the non-qualified brokerage accounts that we've recommended you open on this podcast, then instead of just saying, oh, I have $500, I'm going to put it in right now, and then not putting money in for the next 6 months, take that $500 and say, I'm going to do $100 a month for the next 5 months, and let's see what happens over an extended period of time. But over the long run, at least historically, using tools like dollar cost averaging and consistent incremental contributions has led to a lot of success when it comes to investing over the long term.